may be inheriting some money from someone else, but you may not want it. How do you disclaim or say no thank you to the assets that are coming to you? You can use a disclaimer. Now, before I explain how this works, I want to invite you to sign up for my free monthly newsletter, where I provide the latest updates on many estate planning topics. So you just click on the button below. Okay, so you might think this sounds really weird. Why wouldn't you want to inherit some money? Well, there could be a lot of reasons. Maybe you think somebody else should have gotten it instead, or maybe you have estate tax reasons why you don't want it. Now, here's the problem, right? If you receive the money yourself, and then you turn around and you give it away to the person who you think should have gotten it, or get it out of your estate so it's not subject to estate taxes, that's considered a taxable gift. And you have to report that gift to the IRS if it's higher than the annual exclusion amount, which in 2025 is $19,000. And then that also eats away dollar for dollar at your estate tax exemption. Doesn't sound great, does it? I actually have a video on gift taxes that you can watch that describes that process a little bit more. So what do? You can disclaim the assets, so it basically skips you and goes to the next person in line. First, I want to explain what needs to be in the disclaimer, and then I'll show you how it works. So when you sign a disclaimer, here's what needs to be in it. First, it needs to be in writing. You can't just say, I officially disclaim these assets. No, you need to write it and sign it. Or somebody else types it up for you, obviously. Now, you identify the creator of the interest. That's usually who you're receiving the gift or inheritance from. You describe the interest that you're disclaiming. You state the extent of the disclaimer. That means you don't have to disclaim the entire thing. If you're set to inherit $1 million, you can disclaim 200,000 of it. That's okay. Now, super important, that disclaimer must be signed within 9 months of the date of death of the person who is leaving you that inheritance. You can't extend that. It's a 9-month hard and fast deadline. Now, when I say you need to file it, if you're going through the probate court system, hopefully you're not, but if you are, then you have to file it with a probate court. If you're receiving this money from a trust, then you need to give a copy of that disclaimer to the trustee. So when you disclaim, where does the money go? It naturally goes to the person who would have received the money had you died before the person giving it. You don't get to decide that it goes somewhere else. You don't get to redirect that money to someone else. So let's give an example. Let's say that your mom dies and she says money goes to you, but if you're not alive, it goes to your children. If you disclaim the money that you're getting from your mom, it needs to go straight to your children. You can't say, oh, but I want it to go to my spouse. I want it to go somewhere else. That doesn't work. Also, you can't take possession of that money and then give it to your children and then call it a disclaimer. No, you have to not have touched the money at all.
Hello, did you know that my mom helps people all the way through the state of California from top to bottom? You'll give her a call.
Okay, so here's a few examples of a disclaimer. The first one is a disclaimer trust. So we often include in a couple's revocable living trust the option of creating a disclaimer when the first spouse dies. In fact, you may have seen that in your revocable trust. You may have seen disclaimer trust and you're thinking, what is that? So this is what it is. When the first spouse dies, the surviving spouse can say, no thank you, to the half of the community property or separate property that the surviving spouse is receiving from the deceased property. In that case, that money goes into a disclaimer trust for the benefit of the surviving spouse. And the surviving spouse gets all the income of the disclaimer trust during the surviving spouse's lifetime, and maybe some of the principal, maybe they can dip into it if they're allowed to, but they can't change the terms of the disclaimer trust. And upon the surviving spouse's death, the remaining money goes straight to where the first spouse had intended. So it's almost like a voluntary bypass trust, if you're familiar with that A-B split. And I have a video about A-B splits if you want to watch more about that. That video is called, Should I Simplify My Trust? Okay, so another place where disclaimers come up is where you'd think they'd come up, disclaiming an inheritance. So I have a client whose total estate was over the estate tax limit, and he was about to inherit some money from his dad, but he didn't want any more assets since that would be subject to estate taxes upon his death. And his dad's trust said that everything goes to him, and if he's not alive, it goes to his kids. So he wanted some of the inheritance to go straight to his kids and skip him for estate tax purposes. So we prepared a disclaimer. Within that 9 months after his dad died, he signed a disclaimer saying that a certain amount of the money he was inheriting goes straight to his kids. And he gave a copy of that disclaimer to the trustee who's managing his dad's trust. It works. Now, what if you're receiving needs-based public benefits and you're set to receive an inheritance? Can you disclaim that inheritance? What happens? Well, unfortunately, a disclaimer doesn't work to protect your public benefits. That's because a disclaimer is considered a gift for SSI and Medi-Cal purposes. Even if it never touches you, just the fact that you're disclaiming it means that you're giving it away to somebody else. So let me give you an example. Okay, let's say that you're set to receive $22,000 from somebody, not a huge amount. You say, no, I want to disclaim this because $22,000 will put me over that $2,000 threshold for SSI. So you exercise a disclaimer and it goes to whoever would have otherwise received it. Unfortunately, SSI will count this as a gift. So you divide the $22,000 gift by about 1,100 and that gives you 20. That means that you would be disqualified from SSI for 20 months. That's a long time. You're penalized even if that money, that $22,000, never hits your bank account. So what should you do instead? Well, what you could do in that situation is you could transfer $19,000 of that $22,000 into an ABLE account. I have several great videos on ABLE accounts that I encourage you to watch, okay? In 2025, the annual exclusion amount is $19,000, so you can put $19,000 in, and then you have $3,000 more and you can just spend that down. You would need to spend it down before the end of the month that you received the money. If you have a larger amount that you've inherited, then you would most likely need to turn around and set up a first-party special needs trust. And I have a video called How to Receive an Inheritance While on Public Benefits, and I talk all about first-party special needs trusts there, and I encourage you to watch that. So while it might boggle the mind that somebody might not want to receive their inheritance, it definitely does happen, and for good reason. And I hope this provides some clarification on how you might be able to make it happen. If you're in this situation, please reach out to our office and we can help you to disclaim those assets. But keep in mind that 9-month time deadline, you're already on the clock. And if you'd like to learn more about more trust deadlines during the trust administration process, I have a video on that and I'll see you over there.
Did you know that my mom has a monthly newsletter? Subscribe by clicking below.